So as we go through this, some of the questions that you'll see are probably going to be familiar because I had some of them embedded in the slides themselves. So you'll see some familiar things, some stuff we haven't looked at yet, and we'll go through this. So which of the following is not an external user? And they tell us here that what? All of these are external, right? I think we saw something. Did we go through this same one? Yeah. I think embedded in the slides or in this file. Okay. Which of the following is a primary user? What? Investors and creditors are primary users, although we do have the Security Exchange Commission, IRS, other government entities. Customers, frankly, are users that are not what? Primary users. When FASB is developing a standard, they're thinking about what? They're thinking about investors and creditors as their primary users. That's not to say that they can't consider other potential users, but their main users are investors and creditors. Number 3, in order to increase comparability in recent years, FASB and IASB have made efforts to reduce the difference between U.S. GAAP and IFRS through a process known as convergence. Okay, so what's going on? At one time, 2005, 2006, that time frame, everybody was saying it's not a question of if, but when the U.S. will go over to the IFRS standards. And, there was some back and forth. And finally, they lobbied Congress. Congress got involved and they made a decision the U.S. is not going over to IFRS. But since there was a commitment to some level with the FASB and the IASB to try to have the standards be as close as possible, what they did was they developed the joint conceptual framework. And we talked a little bit about that both of them now work off of the same conceptual framework that we were studying. And the idea is that there should not be a lot of differences between the set of standards if they're both working from the same conceptual underpinning. Okay? So all this process of putting out joint standards where possible, we'll talk about revenue recognition in that regard when we get into Chapter 5, and the joint conceptual framework, etc. All of that is considered convergence. They call that convergence. My prediction, you will never have just one set of standards that everybody uses. Just like there's not going to be world peace, if you're thinking there will be, there won't be. There's always going to be something that big economies like the U.S. want to hang on to their sovereign accounting standards. And so you'll never have one set of international standards is my prediction. But hopefully there won't be a lot of differences as time goes by under U.S. GAAP and IFRS with the convergence process. Okay, any question on that? Sign in next to your name under today's date. Okay, all right, let's go ahead and take a look at this one. Pretty easy. Liabilities of a company would not include what? Cash is obviously not a liability, it's a asset, right? Okay, just getting to our elements discussion. You guys kind of made that little exercise look silly, but that's good. At least I know that we don't have any basics that we have to sit here and reinforce. Okay, the origins of accounting are generally attributed to the works of, did I tell you about Luca Pacioli, right, back in the 12th century? Okay. Number 6, Martin Corporation purchased land in 2007 for $290,000. In 2013, it purchased a nearly identical parcel for $460,000. In its 2013 balance sheet, Martin valued these two parcels of land at a combined value of $920,000. So what did Martin do? He took the 2007 land, and even though he only paid $290,000 for it, he valued it at $460,000, right? Are you supposed to do that? No, it should have been left at the 2007 purchase price of $290,000. Then when he bought this other one in 2013, I guess he must have looked and said, well, this other land's so much similar, I should be able to write the first one up. And that's how he came up with the $920,000. So what did he do? He violated the historical cost principle. For things like land, we carry them at their historical cost, right? Okay. Now, What if these were two shares of stock in the same company? Let's say he bought one share of stock for, whatever, it'd be expensive share of stock, whatever, but for $2.90, and then 6 years later, he bought another share of stock in the same company for $4.60. What should the first share of stock be valued at? We would write it up to $4.60, wouldn't we? Because we treat things like stock that have a readily determined value. I'm assuming the stock was traded, has a readily determined value. We would write that up to its fair value, right? Okay. Question on that? Okay, good. Let's go ahead and take a look at number 7. The private sector organization involved in developing accounting standards is the FASB, Financial Accounting Standards Board. And as I said, they issue those accounting standards updates, and that'll be the answer to one of the other questions coming up. But we're going to learn how to use the codification in here. Codification takes all the different standards from FASB's, from its predecessors, APB, the Committee on Accounting Procedure, and labels them by topic. So if you're looking for something from the statement of cash flows, you just go to that part of the codification to look up anything you need to with the statement of cash flows. And I'm going to give you we're going to practice a little bit with it next time, and then I'm going to ask you to do a research where you'll look up something in the FASB codification, and we'll do that from time to time. Okay. All right. This question's so great I had to ask it twice. Okay. Okay. Andre Dickinson, owner of Andre's Fine Wines, also owns a personal residence that costs $475,000. The market value of the residence is $625. During preparation of the financial statements for Andre's Fine Wine, the accounting concept most relevant to the presentation of Andre's home is what? Economic entity assumption. Should he put the home on his financial statements? On the company's financial statements? No. Personal assets of the owners are kept separate, right? Now, if he somehow brought a personal asset into the corporation or something, then what? He'd probably take back some stock in exchange for that, and then that, of course, would be carried at, on the financial statements of the corporation. Yes, sir.
Can you explain the economic entity assumption? Because in the book it was talking about how Google owns different branches or goes into different companies. They will have to report that too.
If it's all being used under the same corporate entity, then they would have to consolidate those in, is probably what they were talking about. I'd have to see the specific write-up in the book that you're talking about because I haven't seen that. But if I have Google, but Google has different subsidiaries and they're all under a common ownership, then under that common ownership, we would consolidate all of those entities that are under that common ownership and report a consolidated set of financial statements. Is that what you're asking?
Yeah.
Yeah, I think that's probably what they were talking about. That would still be considered under the same economic entity, but because it's all a set of business.
Yeah, this is personal. And it's completely, this is personal.
Right, but if it's personal, then we're not going to put it in. Okay, but if it's something that's all under the same business entity, essentially, but they just, separated out into different subsidiaries and whatnot, or they've acquired other subsidiaries, but they're now all under the same common ownership, then we consolidate those. I don't think we get into it in 1, not 100% sure, maybe we will, if not definitely 2. There's still a requirement, though, for public companies that they still disclose certain segments of their business. So even though we would see consolidated level, those segments that meet certain size tests, and there's a 10% revenue test, a 10% asset test, a 10% profit or loss test that's done to determine if we still have to disclose elements of that or pieces of that subsidiary, certain pieces of it. So we don't completely wipe those other entities off the face of the earth in the consolidation. But that's probably what they were talking about. It's a business endeavor. It's under the same corporate ownership, then you would consolidate them. But personal assets, homes, cars, that sort of thing, of the owners, no, right? We'd be there all day. If you own a stock in Apple, they'd have to say, hey, can you give us what your house value is? Okay. Okay, good. Cost principle requires that when, in a way, just to keep blabbing on that for one more second, that is the economic entity assumption, saying get all the business assets of common ownership under the same umbrella. And that's also another function. We're talking about keeping things separate, but there's also the economic entity assumption is telling us why we have to bring certain things together under the same umbrella and consolidate if it's under the same ownership. And then sometimes, and then I promise I'll stop after this, if it's a private company, sometimes they can do what they want, right? That rule that we're talking about for Google is for public companies. They have to consolidate and show those segments and stuff. Sometimes if it's a non-public company, they may choose not to consolidate certain pieces of the business that are under common ownership unless the potential creditor, investor wants to see that, and then they could ask. And so you could literally have 1 year where I combine certain companies under the same ownership and consolidation, and then in year 2, I select a different set of companies that I'm going to consolidate, and it just depends on what the investors, creditors, or whatever are looking for. So it gets a little involved, that economic entity assumption. Cost principle requires that assets are acquired, they be recorded at cost. And of course, you could ask the question here, this is not the best question in the world. You could sit here and say, well, what assets? Because if we're talking about investments, then we could justify fair value, right? Number 11, the Deuce Company has 5 plants nationwide that cost a total of $100 million. The current fair value of the plants is $500 million, but the plants would stay at what? $100 million under historical cost principle. Economic entity assumption requires that the activities of the entity be kept separate from the activities of the owners, right? The personal activities of the owners. Number 13, we might have looked at this one already. Every now and then, guys, this means I'm borrowing this from the CPA exam material, okay? And I'm actually, I talked to them, and they gave me a login for CPA exam questions, so you can go in and look. All I have to do, though, is line up the way they array their chapters with the way, thank you, sir, with the way the chapters are in the book. Did everybody sign in? Everyone signed in? With the way the chapters are in the book, I'll have to line that up, but we'll be getting more access to some of these CPA type questions. I think they're good practice for us, since I'm going to assume most of you are thinking of taking the CPA exam at some point in time. So, okay, according to FASB and the ISB conceptual framework, useful information must exhibit the fundamental qualitative characteristic, and remember, we had faithful representation and relevance were the 2 key fundamental elements that we looked at, okay? We also had some ingredients of those. For example, verifiability was an ingredient of what? Faithful representation, okay? But it is not in of itself a qualitative characteristic. Comparability and materiality were what? Secondary qualitative characteristics, as were understandability and timeliness. 14, a balance sheet shows assets, liabilities, stockholders' equity. Again, I was putting that up there just in case we had a problem with that kind of stuff. An income statement presents revenues and expenses for a specific period of time, and sometimes my students have trouble with that specific period of time. What does that mean? Essentially what? Quarter or a year, or whatever it is, right? Balance sheet is as and as of date. The income statement is covering a period of time, a year, a quarter, whatever. The primary focus are our investors and creditors, investment and credit decisions. Okay. 17, FASB issues accounting standards in the form of They call those accounting research updates. And the reason they call them accounting research updates is they are updating the codification. So again, in the olden days, we had to keep track of all of FASB standards chronologically, and nerds like me would walk around saying, FASB 95 statement of cash flows, and that was like my big contribution to conversations, that I somehow remembered the numbers associated with them. And when they went to the codification, they took away my powers, right? Because now nobody cares what the order is that it was issued. Everybody cares where in the codification it shows up, okay? So let's just go ahead and look at that codification if they haven't logged me out. I was going to do this last, but it makes sense to do it right here, okay? And so what I was messing around with here before class, and I should have been tending to other things before class, and when they bothered me with that just before class, I could have ignored it. But anyway, what happens is they line everything up now by topic, okay? And so the first three numbers of the codification are always what topic are we looking up, okay? So if I'm looking up something about the statement of cash flows, I obviously know that that's going to be in topic section 230, right? Okay? So if I wanted to understand something about statement of cash flows, I could click right there on statement of cash flows. Where'd you go? Presentation. Where'd my statement of cash flows go? Right there. And then notice it opens up another set of material, okay? And if I'm trying to look up something, for example, statement of cash flows, and forgive me for my favorite topic of governmental and not-for-profit, but if I wanted to know something about the not-for-profit version of statement of cash flows, then I could go down here, right? Okay? For our purposes, since we're not going to be really getting into a lot of detailed areas, typically the things that we'll look at will be in this overall section, okay? So you click on overall, and then under overall, we start getting all of these other subtopics, okay? Or I should say sections, not subtopics, but sections. So far, if I wanted to know something about the statement of cash flows, I'm going to cite that as topic 230, subtopic 10 overall, and then I start looking at these sections down here to see, well, what am I interested in? Now, when you look at these sections, guys, you can almost ignore some of these first ones. It's rarely that the answer to our question is status, overview, background, objective, scope, glossary. I mean, the meat really starts what? Down here in this subtopic 45. Now, what I was looking for, and I apologize I don't have it yet, but we'll get to it next time. I was looking for the question, should we report earnings per share on the statement of cash flows? Not earnings per share, but cash flows, per share. On our financials reports, on our income statement, we'll show earnings per share, and you'll really talk about that more in chapter 2. But we would have to show, the question I'm saying was, will we show cash flows per share, say on the statement of cash flows? And you might have a client that would ask you that. They'd say, hey, I would like to show my cash flows per share on my statement of cash flows. Can I do that? And you're like, okay, I don't know. I don't walk around with that knowledge. But I would look at something like that and consider that to be an other presentation matter. Okay, now the reason I think it's other presentation, because putting a cash flow per share on the face of your statement of cash flow would be a presentation issue. You go back, not to other presentation matters, but to overall. If you go back to overall, I don't know, you could think that's a disclosure issue, but disclosure issues are usually talking about what? Footnote disclosure. That's not what they asked you. They asked you what? A presentation matter about something on the face of the statement of cash flow. So now we're into sections. 45. And now all we need is the specific paragraph that would answer the question about cash flows per share. So when I go into presentation matters and I start looking around here, and this is where I got a little lost, guys, and part of the reason I was late, because you get into this nerdy accounting thing and you have trouble stopping. My understanding is, the way I've seen this in the past, and I'm not sure why this isn't comporting to what I expected, was that we should be able to search in this particular section on the words per share, and it would tell us, and here it would highlight for us, whether or not our cash flows per share should be presented. Now I'm just kind of scrolling through. And I'm not seeing it. I'm not seeing it there. So this little example kind of falls off if I can't find it. But what I'm going to do, and I'll find it for next time, show you the best way to find it. But what I'm going to try right now, sort of like live television here, I'm going to try to find the phrase cash flows per share. Because there is the approach where we went on the, we knew we were looking for some statement of cash flows, and we kind of followed the chain down. But they also have this search engine, okay? And you can always search out what you're looking for. And let's see if it gives us anything. Earnings per share, statement of cash flows. Okay, let's see. Overall, other presentation matters. Okay, good. Maybe I'm going to get lucky. Let me click there on that. And okay, there it is. I went too fast past paragraph 3. Okay, you see here how it lit up the words per share. So that search engine was pretty useful, right? And they pretty much got us right where we wanted to be just by searching more specifically on what we were looking for. I was kind of going through the approach of, I was using the force to say, okay, what should it be? You know, reach out with your feelings, Luke, and I kind of got in there. The search engine is the lightsaber. And then, hey, if you want to get straight to what it is you're trying to get to, then maybe you use that, because that got us here pretty quick. And it tells us that financial statements shall not report an amount of cash flow per share. So they answered it for us right there, didn't they? Okay. So the citation then that you would give to your client, I'm just using a different color, would be what? It's topic 230. It's subtopic 10, section 45, paragraph 3. Dear client, says that you shall not report cash flow per share. Can't do it, right? And you might have a client, you may know that off the top of your head. You may have known the answer to that already, but you'll have a client that will say, well, that's not what I heard. I was talking to someone, they said, right? And when you can show them like that, facts are sharp, pointy little things that have a way of ending stupid discussion a lot of times. So.
Can you go to the search engine and just put 230-10 and it'll take you straight there? Or do you have to just go through and manually?
Well, again, I was doing it because, I'm kind of feeling it, was sort of feeling it. Okay, but are you saying, do you want to search right here on two?
Let's say you give that to someone, or somebody gives me that, can I just go to the website and put in 230-10-3 and it'll take you to that place?
Oh, where they can see it?
Yeah.
Oh, no, I don't know. I don't think so. What they have here, though, is I think, and I'm going to have to look into that, there's somewhere on here, I don't think it's submit feedback, because I think that's them. wanting you to tell them something. Now I'm stuck in this submit feedback probably. There's a way of mailing this to somebody, and I'll show you how to do that. I'll have to figure out how to do that, and I'll show you how to do that. But you can mail this citation, and then they can go in. I see what you're saying is you want them to go look at it for themselves, right? Yeah, of course, they have to also have access to the codification as well. But yeah, you could also mail that to them, and I'll show you next time how to do that. I see what you're asking. You can mail this up to somebody, and they can get it on the link. Okay, so what we'll do in here, guys, is once I get you the access, and I'll put that up on Canvas so that you can access it. And then what we'll do is from time to time, I'll have you practice with it a little bit. And then we'll have a research project where I'll ask you all to give me the same answer to the same question. We're not going to make too much out of that, so you can go in and you just give me the citation or whatever, write something up about it. Okay? Any question? Okay, good. So when they update this, going back to the test, they update this through the accounting standards update. Accounting standards update updates the codification when they come up with a new standard. Okay, good. Number 18, CPAs are licensed by the state, right? Now, the CPA exam itself is worldwide, right? But each state administers it. So sometimes I'll get students say, well, what's the California CPA exam like versus the Washington one? There's no difference, okay? They're all the same, all 50 states, territories, whatever, that take the CPA exam, the US CPA exam, all have the same exam. The requirements to sit are different from state to state. For example, in Washington, you can sit for the exam 6 months in advance of having completed your bachelor's. So you can sit for the exam 6 months in advance of having completed all the requirements. The only difference is that to sit for the exam, you only need 120 semester units here in California, whereas in Washington, you need 150 semester units to sit for the exam. But I have some students that already have the 150 because you need the 150 for licensure in California, and I've had a handful of students that have gone ahead, applied through Washington, taken the exam 6 months before they graduate, and California will accept your score as long as you do not sit for any part of the exam before you met the requirements. So that's easy enough. You register, Washington approves you, and you schedule your first exam for, say, July 1st after you get out of school. Maybe your degree was earned in May, and you can sit for the exam a little faster than if you go through California. California won't let you do it until after you've sat, but then you have to wait for San Jose State to stamp your transcript. By the time San Jose State stamps your transcript, it's already June. Then you have to send it into California, wait for California to take, 6 weeks to process your paperwork. You're not sitting for your exam until October. With the Washington route, what happens is a couple of my students that went that route were literally, when they were starting for the firms, where a lot of people were just getting started on their exams, and now they're trying to, start working and all that. They had already finished their exams when they walked in the door, or finished like 3 of the 4 when they walked in the door. So that is a way of getting around it. I complained to the Cal CPA about this. Why should California CPA students fall 6 months behind Washington, and can't we come up with something similar here in California? And they said, well, you're the only one that seems to be complaining about the process. And I'm like, okay, well, I talk to hundreds of students, every year that tell me, hey, this is a problem. Is there any way to get around it? So anyway. Okay, which of the following has a statutory authority to set accounting standards in the United States? SEC, right? But they delegated that to the FASB, okay, but they still look over SEC's shoulders, over their shoulder. What is the registering company? When a registering company submits its annual filings to the SEC, that's a 10K. Did we look at Apple's 10K? We did, right? Okay, I think I asked that every class now, right? 10Q is the what? Quarterly statements. Q stands for quarterly. Some of these other ones, like this Form S1, when you see form numbers and there's form, they call it a form, and there's no number with that, that usually means that's non-financial data. So when it's just letters and, well, this is what, an S1? So that's not a good example. Some of these, there's no numbers, it's just letters, and that's non-financial, like the CEO's name, that kind of stuff. It also gets submitted. Number 21, the most likely important flaw leading to the demise of the APB was the perceived lack of independence. What was the problem with the APB's independence? What was the problem?
Companies were putting the rules for the same people who are putting the beneficiaries.
Yeah, ballpark, yeah. You want to add to that?
I think you mentioned something about if some of the employees were not full-time, so they also looked for other companies.
Well, yeah, I kind of said that. I kind of threw that in towards the end of that discussion. Yeah, and that was a big deal. They were part-time. They would come into, I guess it was probably New York, because the American Institute of Certified Public Accountants is in New York. So they would host these meetings where they would come in periodically, set the standards, and then they would go back to what? Back to their respective companies to be CFOs and be auditors and all that kind of stuff.
And I think funding also, like it wasn't the way it is now, it was required.
The funding came through the financial accounting, well, there was no financial accounting foundation at that point. The funding for the whole process came from the AICPA, American Institute of Certified Public Accountants. And as I said, where does the AICPA get its money? From CPAs paying their dues. Well, where do CPAs get their money? From their clients. So there was a potential there that a client, a company, a big company, I'm not going to pick one out. Okay, I will. Chevron, let's say. You know, I doubt Chevron did this. Big company like GE, somebody like that, comes in and says what? Well, you know, I don't really like the way we're doing accounting for contracts or something like that. You should really take another look at that. And they keep pushing through a political process till they get the standards to match what they want. Is that what we need? No, we needed what? A private, not-for-profit organization that became the FASB, right? And they did that because there was some concern about the independence of the APB, which was housed inside the AICPA part-time board. FASB became a full-time board. How did we fund FASB for a long time, though? Through that Financial Accounting Foundation. And the Financial Accounting Foundation was getting money from the companies. So they pulled it out of the AICPA, but they hadn't quite completely removed some of the conflicts in terms of the funding. And then in Sarbanes-Oxley, they said, well, if you're going to be a public company, you have to pay to play. So public companies have to pay a fee that then goes in and funds the Financial Accounting Foundation. They have to do that if they're public companies. So we've moved the independence up a little bit, but you know, FASB is still in the middle of a political world in that what? If they try to adhere too close to their conceptual framework and they do something that they think is right, the SEC is still sitting there, isn't it? Is the SEC a political entity? Oh yeah. Is the president a political entity or whatever? Yes, it is. And the president appoints the person that heads the secretary of the SEC. He appoints that person, he or she. He appoints that person. And so there's politics there, in that there was a case where the FASB wanted to issue a certain standard on how we account for our stock options. And they wanted to set it up so that a company would have to take an expense for the stock options that they offered to their employees, because we knew that the employees were working hard, knowing that someday they would what? Get a nice price on the stock options. They would put the price of the stock option at $25 a share when the market value of the shares were $35. And because they put the option price, the other way around, they would put the option price at $35 a share when the shares were trading at $25 a share. And so what happens? nobody's going to exercise a $35 per price share when the trading price is $25. Meanwhile, everybody knew that sooner or later, not too long, in 3 years or so, the price of that stock was going to be $50 per share. So they were ignoring this. As long as they put the stock option price above the market price, they knew that they wouldn't have to take any compensation. So they were expense. So they were deciding what they would have to report in their financial statements just by where they set that option price. But that's not how we do things in accounting. So FASB came in and said, no, we're going to make you value those options. And the value of those options will automatically be considered the compensation expense. Well, Congress got involved and came in and said, Joe Lieberman, who, in my opinion, walks around like a hero now all the time. But anyway, Joe Lieberman came in, he's no longer in Congress, and introduced legislation, because he was a senator from Connecticut, that if FASB wanted to put anything on its agenda, it had to get SEC's permission first. Well, if you have to get a permission to put something on your agenda, you're no longer a board. And so they're going to take the teeth away from the FASB, and FASB had to back off of what it knew to be the correct decision. There was no way that they should be able to, mess around with the option price to avoid recording expense. That's not how we do things in accounting. So, a little while later, it was like maybe 10 years later, that was like early 90s. 10 years later, there's a big scandal with how companies were dealing with their stock options and some shenanigans in there. And then FASB said, aha! And they went ahead and issued the standard and said you have to do it the way we were trying to 10 years ago. And then it went through. So FASB still, even with these funding mechanisms and everything we do, it still operates in a political environment, right? It can't always do exactly what it wants to according to the conceptual framework. Okay? All right, so we come over and we look at the Norwalk Agreement, and the FASB and IASB pledged to try to remove existing differences between their standards. Like I said, they'll never get there 100%. I mean, it'll never happen entirely, but they call that the Norwalk. That's where FASB is in Connecticut, Norwalk, Connecticut. So they called it the Norwalk Agreement. Okay. Which of the following is not a concern expressed by the SEC regarding IFRS adoption by the U.S.? Let's see. A, it's not a concern. A need for U.S. to have strong influence on standard setting process and ensure that the standards meet U.S. needs. Okay, that was something that I think some of you suggested, and that what? If we just said we're going to follow IFRS, we would be giving up our power to what? To set standards, although frankly, I'm not too impressed by that reasoning, because the U.S. could still have strong influence over the process by its virtue of being a leading economy. B is the answer, language barriers. That's nonsense. I mean, you can always have interpreters, and when you have interpreters at the level of what's going on here, these are excellent interpreters. I was in Japan, and we had a situation where we were at a press conference with Becker, and they were the company that administers Becker in Japan, and they had this big press conference, pony show thing. And the main thing I was impressed with were the two interpreters. They were amazing. And that not only did they communicate the words, but also the emotion of what the person was saying. So a lot of times you hear these interpreters and they're just blah, 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 like robots. If you get a good interpreter, not only do you understand what the person is saying, but the emotion and the expression behind it as well. So, tip-top interpreters, this is not a problem. C, the high cost to companies of converting to IFRS. I think in our little discussion, we brought that up, didn't we? We had said that, hey, to convert to IFRS is pretty costly. D, the fact that many laws, regulation, and private contracts reference U.S. GAAP. Okay, that would be a problem as well. And further, the big one is that IFRS does not, my opinion, the big one is that IFRS does not allow the last in, first out inventory method for accounting for your inventory. We'll talk a little bit more about that in here. In this class, LIFO does what? Lowers your net income in periods of rising prices. Lower net income means what? lower taxes. And the U.S. tax law is that if you don't use LIFO for financial reporting purposes, you can't use it for tax purposes. So you were having big companies like Chevron, Exxon, et cetera, that if you took away LIFO for tax purposes, all of a sudden they would have to start booking expenses, tremendous expenses on their deferred tax liabilities, et cetera, and they didn't want that. So they went to Congress and paying more tax and lobbied strong and hard against IFRS and said all kinds of crazy things like, if you go over IFRS, you're going to be bilking the public and all kinds of things. So just really, that's why I say I don't think it would ever happen, that the U.S. would just go over to it. 24, the political issue in the FASB's most recent deliberations and amendments to GAAP on stock options was the negative effects on earnings of companies in the tech industry if they had to recognize the expense associated with the stock compensation, which is what we just talked about. What a lot of these tech companies, particularly here in Silicon Valley, they offer stock options to attract talent because it doesn't they don't have to come up with any cash. They offer the stock options, and then they go ahead and work hard, and the stock price goes up, and then they exercise the options. And having to put that expense down in the financial reports, if they had to value the stock options, a lot of the tech companies were saying, you're making it very hard for us to attract talent, et cetera, to raise capital, and that was one of the big arguments that was against it. Number 25, independent auditors expressed an opinion on the fairness of the financial statements. We saw that, EY's financial report. Okay, let's take a look at this one. Which of the following best describes an operating procedure for issuing FASB standards update? Exposure draft is modified per public opinion before issuing a discussion memorandum. B, new accounting standard update can be rescinded by majority vote of the AICPA membership. Hardy har har, we know that's not right. Okay. C, an accounting standards update is issued only after majority vote by the members of the FASB. D, the emerging issues task force must approve a discussion memorandum. Good. C, we have the accounting standards update, and they are what? Updating the codification, and it's after a majority vote by the FASB, 4-3, right? Okay. That's it. Okay. Any questions on any of those? Huh?
Number 10.
Number 10? Did I skip it?
I think it's actually correct.
The cost principle requires when an asset is acquired to be recorded at cost. And I made the point that there's a little problem with that question because it depends on the type of asset. If we were talking about an investment of some sort that we're carrying either as a trading security or available for sale security, we carry that at fair value on the balance sheet. Held to maturity securities, which are bonds essentially, we tend to carry at amortized cost, unless they've dropped, if there's impairment there. And that's the case, frankly, for any asset, if there's impairment. So even for like land and buildings and equipment, we were saying, hey, historical costs, unless what? Unless its fair value has dropped below the historical cost, then you'd write it down to that lower fair value at that point because it's dropped below the historical cost. Okay, did everybody sign in? Okay, so we'll get out a little bit early. Next time, chapter 2, and I'm going to put up the login for the codification, and we're going to mess with that a little bit more. Okay? All right, guys. I'll see you on Wednesday. Make sure you signed in, please. Damn it. Quit fucking with me. You, fuck you, fuck you. Hi. Yes. No, I'm going to give you guys a link. I'll put it up on Canvas. And there's a link with a password and a username. And you can... No. 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 It comes with the class. Yeah.
For the exam, is it gonna be like a quiz
Yes. The only difference is, and I'll have to start putting some examples up as we get closer to the exam date, we'll have some free response, where the quizzes are multiple choice. But I'll start putting up some that'll be like the free response ones. Yeah, and then I'm not sure how I'll test you on the codification. I'll have to see, I might give you something that, I don't know. We'll see. I mean, I'm not going to have you do a search in class or anything. We'll see. But there'll definitely be a little research project, but it'll be really easy.
But is it gonna be like the it's like this is like a theory, right? Like things that we just learned.
Theory?
Yeah, it's not like we learn like the accounting.
That's coming.
Oh, okay.
Yeah. We start out with the theory. We'll start getting into more of the numbers next time. By the time we're in chapter 5, we're full blown back to knowing how to handle transactions and stuff. Sure. Okay. See you next time. What's your name? Gabriella. We'll see you next time. Bye-bye. Have a good day.